You're listening to Investify, preaching financial independence and assisting investors to achieve a more flexible and free lifestyle through smart financial planning and real estate investing. If leaving the corporate world and jumping into this thriving industry is what you desire, tune in and listen to stories of like-minded individuals who made the leap to financial independence. Equip yourself with the right tips and tricks to start your real estate journey, making active or passive ventures that are highly profitable and rewarding. Here are your hosts, Craig Kurlop and Ziana McIntyre.
Actually giving everyone a free download of the book. So I highly recommend it because it is a great book. We talk a lot about taxes, how to save in taxes. We talk about investing in funds and syndications. So there's a lot of really good information here for investors that are hoping to do some more hands-off investing. Maybe they feel overwhelmed by real estate. And so, yeah, I suggest sticking around and let's bring in Dave. Dave Mason, welcome to the show.
Thank you so much. It's great to be here.
Yeah, so I know you from, I don't exactly know what I know you from, but you reached out to me when your book came out, The Cash Machine. I think, was that a year ago or longer now?
It was actually right before COVID. It came out in January,
Amazing.
just as 2020, and I did something that fall called Financial Independence School. And I've interviewed you and Craig were two of the people that I spoke to during that.
That's awesome. Wow.
Yeah.
Well, it all comes together. So yeah, I mean, I loved your book. So just if you guys haven't heard about it, The Cash Machine is just really a cool way of teaching about financial independence because he teaches it in a novel kind of setting. And so it just feels like you're reading a story and you get excited about the characters and it's really easy just to understand the concepts in that way. So I really appreciated just the way that you guys laid it out. So yeah, thanks for that book. And it's a great read for probably even younger people if you're trying to get like your kids into it or something like that. So yes, but we want to hear about your financial independence journey. So first, the way we kind of lay out the show is we ask you how you first heard about financial independence, and then we'll talk chronologically through your story. So how'd you first hear about it?
I think I first heard about it when I was kind of picking up the pieces on the financial disaster that I'd made of my life.
Oh, and this sounds good already.
Yeah. And it came to me, I'm like, oh, wait a second. That's what I should have been aiming for. Had I been aiming for that early on, everything would have played out entirely differently. Which is kind of a segue into the story, I suppose.
Yeah, tell us about the disaster first. Where were you when you figured this all out?
So here's the funny thing. I was an attorney first. I was a nonprofit attorney, and then I wound up moving to Israel and starting a family here and making the shift from that into the business world. And we were doing okay for a little while. As long as we were making enough money to get by on, we were doing just fine. And then the business started doing a little bit better. We were making a little bit more than we needed to get by on. We were still doing just fine. Then we had a problem. We started making twice what we needed to get by on. 3 times, 4 times, 5 times. We were making a lot of money and we didn't know what to do with it. We didn't know, well, what do you do when you have more money coming in than what you need? Now, looking back, that I know about financial independence, I would have said, okay, I would have continued to live very basically. I would have taken as much money as possible and invested it because my business was one that I really didn't know how many years it would be strong. It was kind of riding a certain wave and I didn't know how long that wave was going to last. I would have taken money out of the business and built up investments. And I think I would have hit financial independence within 5 years of starting my business had I really had that as a goal. Yeah.
So, I mean, one thing that I noticed as a business owner, especially since I become a real estate agent, is that it's so easy to blow money or reinvest back into your business and not know if it's going to be paying off. And so I'm curious how that works for you guys. I mean, maybe that wasn't a business that you wanted to keep investing in, but my personal life, my spending is really minimal. But in my business, it sometimes takes on like this crazy thing where somebody says, well, you know, it's $5,000, but it only takes one client. So if you get one client, it's worth it, right? And all logically, that sounds good, but too many of those and you're underwater.
Exactly. And we rationalized the dumbest expenses in our business. And on our personal lives, we were spending not that much. And we rationalized so many stupid expenditures. And we kept feeling like, okay, we know what? We know a lot of bright people who are struggling to make money and to get by. And, it's a great thing to be giving people jobs, and they're really smart. So I'm sure they'll figure out how to become valuable over time. Right. Boy, was that a total waste. We wound up getting ourselves into debt to be paying other people's salaries who the business didn't even need. We thought we were doing all this, great charitable giving by giving people jobs. When the business basically went under and I had to get rid of everyone landed on their feet. And it took me years to dig out of the debt I'd taken on for that. The other big error, so that was really the big error on my side. And then my wife had another big error in that she really wanted to own a house, and she wanted to be fixing it up right away because she didn't want to have to later move out and be living there and have to leave in order to fix it up. It needed some work. And we wound up investing so much money into this house when really we didn't necessarily have all that much. And we sunk ourselves into a huge house debt too. We made ourselves house poor. It was only later when we read Robert Kiyosaki, and he's like, whoa, a house can be a really bad investment to be dumping all your money in. We were living in a large house with the expectation we might have a large family down the line, which we never did have a large family. And we had this big house and we made it super fancy. And then we got stuck with it as actually the dollar went down versus the shekels. We got ourselves into all of this debt, and we couldn't even, what we paid for the house and what we were able to get back for the house were not at all level. And those two things, we trashed ourselves in my business and we trashed ourselves in the house, and we were just staring at a ton of debt.
Yeah. And so you mentioned the shekel. So tell everybody where you are, because I imagine, I don't know, it might be easy for people to think that financial independence stories are a very Americanized idea, but you're taking this information and you're sharing it with the world. So where are you guys based out of?
So we actually live in Jerusalem. I moved here when I was 29. So I grew up in America. I grew up in Connecticut, and I was, like I said, I was an attorney in the US until I moved over here and decided to go into business. And I have to say that I definitely, from an American standpoint, I do tend to fall a bit that way. I find people will look at how successful Israeli businesses are these days and say, oh, it must be a really good business culture. There's no. Israelis are very good at coming up with businesses. The business structures in Israel, I've had some experiences with that, almost drove me under. And to me, it is not the place where I want to be investing or building business. I've actually recently started doing more things internationally, but really the US is actually my place of comfort, despite the fact that I live in Israel. Most of my investments are still going to be US based, but Israel is definitely where we live.
Awesome. So, okay, let's go back to your financial independence discovery. How old were you? What year was it? And then what did you do to make the switch?
So really, we got clued in just a few years. Let's see. So we came out with the cash machine in 2020. It took 2 years to write the cash machine. So really that right around then, like 2017, 2018 is when we were really discovering it. And I had this whole insight that as a novelist, I learn best when I'm researching a topic for a novel. If I wanted to learn financial lessons for me to implement, then I'd learn, this much. I'd learn a small amount. But in order to teach it, I need to understand it so much better. I need to understand all the nuances. So it was actually when I realized I needed to become financially independent, that was the spark that got me to start writing the cash machine. I didn't write the cash machine because I was a financial expert. I wrote the cash machine primarily for myself because I knew the process of writing it would force me to get a vast financial education. And so those 2 years from 2018 to 2020, when I was writing the cash machine, my understanding of money just went through the roof.
Oh my God. Okay. So I'm loving this because I did just release a book on medium-term rentals, but what I really want to write about, like my passion idea, is that I want to write about money psychology. And I know before we got on here, you just talked about how you guys have a program where you're helping people get over their kind of like money hurdles, emotional, maybe like glass ceiling and all kinds of beliefs that they're holding that keep them from attracting or allowing money into their lives. And so it's the same for me where it's like, I know I still have money hangups and I'm on my own journey of learning how to like overcome them. And I think this is exactly that, where it's like, there's almost this imposter syndrome of like, can I write about this when I'm not there yet? But in writing about it, you will be on the path of discovery to figure it all out. Right. So I think that's like really exciting.
Yeah. I would have hesitancy about publishing a book if I wasn't there, but starting a book is the exact opposite. Starting a book makes you take a hard look at where your own holes are and fill them. So you can 100% start the book on that. And then by the time you publish it, hopefully you will have gone through that, but you need to take an honest look at yourself and say, okay, I want to talk about money mentality. Let's look at my own money mentality, the places where I have holes. Let me fix them. And you know what? I can document that journey in the book. I can be talking about that. You know, when I sat down to write this section, I had to look at myself and say, I wasn't there. Okay. How do I get through this? So that actually brings us to Money Mindset Madness. This is
tell us all about it.
This is a course that my wife and I wound up creating a few years back. And actually the first step of Money Mindset Madness is figuring out where those money blocks exist. So we give a whole assessment. We give you actually 40 questions to go through. And each one, it's very, very simple. It's literally just a statement. And you say to the degree that you agree with it or you disagree with it. So one of the statements is money is the root of all evil. If you put down, is it a 1? That's total garbage. I don't believe that at all. Or is it a 7? Yes, I completely relate to that statement. And you go through, we encourage people to go through it really, really fast because we just want your first gut reaction. If you take time and think through them, obviously all these statements are false. But emotionally, that's what we want. Emotionally, we tend to really attach ourselves to a lot of not so healthy beliefs that hold us back. So you go through and you answer all these questions and you figure out which ones are really holding you back. So for example, one of the first times I realized the power of this, I was actually in my kitchen. I was doing dishes and a guy comes over, a neighbor, and he's like, can I talk to you? I'm really struggling financially. And this was a very bright guy. And he was highly skilled in an area where people pay a lot of money for skilled practitioners.
Yeah.
But he didn't live on that much money. And even so, he was having a hard time covering his expenses. And he was talking about all these things he was doing and how they weren't working. I said, out of curiosity, complete the following sentence. Rich people are. And he said, greedy. And I said, money is. And he said, the root of all evil. I said, do you think you might have a hint here as to why you're having a hard time, like going out and charging people? Like he wouldn't want to work with rich people because he hated them. So he'd find people to work for, but they couldn't actually afford what he wanted to charge. And even if he wanted to charge a lot and did wind up charging, he'd wind up hating himself because now he'd be evil and greedy. So we want to look at ourselves as being good people. So if we have beliefs that say success financially is going to make me a bad person, it's going to make me greedy, it's going to make me evil, we are going to stay far away from that. So we go through these 40 beliefs and we help really identify what are those beliefs that are genuinely holding people back. And then we go through a whole process of getting rid of those beliefs. That's step 2. And then from there, then the third week is, okay, well, now we need to fill those vacuums. Let's think about some really powerful, healthy beliefs and help you understand why those are as true or more true than the things you had before. They can help you really move forward.
Amazing. Okay, cool. Well, I'm so glad that you guys are out there doing this work because I think we just it's like a rising tide lifts all boats, right? As we help other people, it just improves the community. And I think, then those people can go out and help more people. So I want to go back to your story because I feel like people would get a lot from your kind of pivot point. So when you first heard about financial independence, what were the levers that you changed in your life and what were the investments that you made that started to help you get out of your debt and over to just a positive net worth?
So getting out of debt and positive net worth was actually before financial independence. That was making the choice that we needed to sell that house. We'd put all that money into the house, and we needed to just get rid of it and sell it. And that was tough. This was the house we thought we were going to live in for the rest of our lives, and we put all this money into. We had so much stress in fixing it up, and it was a really beautiful place. And it was tough going from being a homeowner in a place we wanted to live to being a renter and making that shift. But we first said, okay, we just want to get rid of all of this debt, because all the money we're trying to save for investing is just going into our debt payments. It's not allowing us to really move forward. So we took a major step backwards and we sold the house. And then we had money left over from the sale of the house. And we're like, okay, well, you know what? We should put that into the business. Again, business can always be a place of putting things in. When you have extra money and you justify putting it into your business, that is some of the worst money you will ever spend. And then when we started learning about financial independence, and we really looked at our own beliefs. So we looked at our beliefs. As I point out in Money Mindset Madness, we go through 40 beliefs. The one that I scored the highest on consistently over and over again was investments are hard to understand. And that was my real problem. I'd get more money. Like I said, at the beginning, when my business was just making enough for us to live on, we were doing fine. When we were making 4 times what we needed to live on, we got stressed out because our savings account was just getting more and more money in it, and it was earning like no interest. So I was feeling guilty and stupid for having all this money sitting and accumulating and not doing anything with it. But I didn't really feel comfortable investing it. And so, here I am. I'm a religious guy, and I'm also happen to be an Orthodox rabbi in Jerusalem. So, we have this whole sense of like, God looks at you and very benevolently says, oh, are you stressed by having all this money in your bank account? Don't worry, I'll make it all disappear. It's like,
be careful what you wish for.
Exactly. You're being stressed, no problem. That money's causing you stress. It'll be gone. Don't worry about it. And you know what? Yeah. You can dig yourself into such a deep debt hole that now you can work really hard, and you don't have to worry about having any money to invest, because it'll all go into paying down that huge amount of debt. But once we sold the house, the debt was gone. We had the money. And again, we did stupid things with it. And then like, okay, enough is enough. We need to learn what we're doing. I need to write this book on money. And one of my biggest shifts in getting over my fears of investment, first of all, it was shocking how easy it was to get over that belief that investments are hard to understand.
Because it can be pretty simple.
Investment, yes. The problem with that belief, and I meet so many people with this belief, the problem with the belief is that it's true. There are investments that are hard to understand, but it doesn't mean that you have to be involved in those. There are also investments like taking money and putting into index funds that are really, really, really easy to understand, and you can implement in just a few hours, and you can just automate it, and it can be really easy. Now, I didn't actually go that direction, but just recognizing that and said, oh, there actually are strategies that are easy. I can take ownership over my investments. And because I was learning so much, I was looking at index funds, but really I started getting excited by private equity. And this was a big,
I'm surprised.
This was a big shift for me. So the first big series of investments that I wanted making, and this actually came about while researching the cash machine. I was actually interviewing some people about real estate, and these guys were helping me to understand things. Some of the local individuals who really specialize in this reached out and helped me to get my head around certain principles of real estate. And a couple of them mentioned, when I mentioned I was looking for investments, they said, oh, a couple of them said, we've got some investment things. We can introduce you to people. And I wound up investing in things like nursing homes and college dorms, student housing. And these were interesting because I really wanted to get involved in real estate. I was learning a ton about real estate, but I was living in Israel, and the real estate numbers in Israel were very different from America. I wanted to invest in America. Yeah.
Yeah. So, I mean, that is a big problem for a lot of people in other countries. Like in Europe, the numbers just don't make sense the same way because they don't have the 30-year fix, and rents are not high enough. So the cash flow is really hard to get. But I just want to clarify for people listening, were you buying these through like a syndication or a fund where you're not the active person, but you're putting in money with a bunch of other investors, and then they're utilizing their money to go buy value add college dorms or, nursing homes and develop those.
Exactly. So that's what I like.
Perfect.
I was meeting people. So I have no role in the management of any of these things at all. Yeah. I get, sometimes I get with the student housing, those guys actually give me a lot of information. Every month I get an update on what's going. And every single month they're at 100% occupancy because there's not enough student housing in the area where they are. And they say, here were our costs this month. Here's what we made. And I just get a monthly statement and nothing is expected of me at all. In the nursing homes, I don't even get those types of updates. The returns are higher, but partially because there's not any money put towards investor relations at all with the people I want to be investing through.
Yeah.
But that's a company, like they've got investments in a lot of different nursing homes. Each nursing home is its own investment. And these people have just turned around a lot of nursing homes. And because they've got so many of them, they're able to negotiate really good rates on, say, all the pharmaceuticals they need. They're able to use economies of scale. So they can go into a failing nursing home, make some changes, and then they have a whole payback structure that is very favorable to investors. And, because they need the money to be buying the homes. We put in the money, and like the first 10% comes back to the investors before they wind up getting their cut for managing the homes. And what was really shocking to me the first time I invested in that was I was excited about the returns and the fact that I'd be taking my money and making it into, monthly income. I wasn't expecting the tax advantages. I was shocked at how much it saved me on taxes. They did a cost segregation, and they were able to
depreciation.
They were able to get all this depreciation into that first year. And here I was making money, but as far as the IRS was concerned, I was losing money. It's like, wait a second, this is really crazy. I'm getting checks, and yet very legitimately, they're telling the IRS that I lost all this money this year in this depreciation, and suddenly my taxes are going way down. And the first year I got a lot more in tax savings than I got in payouts.
Yeah. So I just want to go into this concept a little bit for the listeners, because some of them are new investors. And so the way cost segregation works, I don't know all of it, but it works really well on syndications. Some of them, if they're value add, so maybe apartment complexes, and some of the things it looks like maybe the nursing homes, they were doing value add. So they're able to use kind of the idea of like, they're going to do all these expenses up front to get it up and running. And so everyone gets to write that off in the first year. And so you get to do like a 90% to 100%, depending on what the asset is. And they're actually going to be lowering that in coming years. So it is really good, even still just this year in 2022. But after that, it's going to be less so. But some people, because of that, will invest in one of these every year because you get that bonus depreciation up front. And so if you plan it well, you can be getting that year after year for your different investments. So that is exciting.
Yeah. So I'd explain it a little bit differently.
Great. Go ahead.
It doesn't actually even require you to be putting this upfront money in at all. What it basically says is you buy a property, and for residential properties in America, they depreciate over a period of 27 and a half years. For commercial, over 39 years. But what's interesting is that when you buy a property, it's not all, say like you buy a house or an apartment building, it's not all building. There's a bunch of other stuff in there as well. So for instance, there's land that's built on, so the land never depreciates. But the structure does. It depreciates again over 27 and a half or 39 years. But you could also break it down into its various segments, because there are things that are not actually part of the building. So you can say, for instance, that all of the money that had gone into landscaping, and it didn't have to be the money that you put in, it could be in the past, all the landscaping improvements, well, those depreciate over, say, 15 years. It could be that the buildings had furniture. The nursing homes, they might have had beds and the heart monitors and all kinds of different equipment. That stuff depreciates over 5 years. And the flooring could be separate. The cabinets can be separate. All of these things can be broken out. So it could be that, say you bought a place for $1 million. It could be that the land was worth $200,000 and the house was worth $800,000 that would depreciate over 27 and a half years. But if you do a segregation, you might find that actually the land is 200,000, the house itself is 600,000, but the furniture and the lighting and the cabinets and the landscaping improvements, that might be $200,000 worth of stuff. And recently they had allowed you, even though it's supposed to depreciate over 5 years for like the furniture, 15 years for the landscaping, they recently said for a short period that, as you pointed out, is going away, that you could accelerate all of that into the first year. So you could literally wind up buying that property for $200,000, for $1 million, and you might only need to buy that $1 million property. Who knows, if you financed it right, you might have got the $1 million property for $100,000, but you might be able to depreciate $200,000, knock out $200,000 of your income in the right circumstances for tax purposes in that first year. It could be really powerful stuff.
Yeah, definitely. And so the thing that's going away is that this year it's still that you could go up to 100% of bonus depreciation. Next year, it'll be 80% as the max. So it doesn't completely go away, but it's less. So if it's something that you're interested in looking into, reach out to me. I have a CPA that specializes in this. And so if you have any short-term rentals or syndications, there's different products that you can do a cost segregation study on. So yeah, super exciting. Well, thanks for bringing that up, Dave. I think a lot of people don't know that. That's important stuff. Yeah. Okay, great. So you started investing in these private equities. What were the investments required? Because I think people don't realize that a lot of these have a minimum. What I usually see is at least 50,000, but what were you seeing?
The lowest I got into were at 25,000.
Okay, great. So that's pretty doable. I mean, if somebody has 25,000, maybe before, while you're saving up to that, you could be having it in index funds and then you could move it out afterwards. And at 25,000, unless you're house hacking, you probably don't have enough for a house. So you could be putting it in these private equities. And then oftentimes they only hold them for a shorter period of time. So some of them are 3 to 5 years, some are longer. But once you get the money out, then you could go invest in real estate if you wanted to, or roll it into a different fund. So what was your path?
So I tend to like the ones that actually never give you your money back.
Okay, great. So they just pay out dividends, right?
Or that never end. What they do is, so the problem with the bonus depreciation when it's a 3 to 5 year period, depreciation is kind of a legal fiction. It's saying that we're going to treat the property as if it's going down in value, even though most of the time property is going up in value. So they give you the tax savings up front for that. But if later, 3 to 5 years later, they sell that place and they show that actually, no, that place you bought for $1 million is now worth $1.2 million, they'll say, yeah, wait, all that money that you took as depreciation, no, you owe that back.
Owe us back.
Because it was actually a fiction. So I actually like the ones that don't sell, but refinance. So so you have a nursing home and it's making a certain amount of money and the bank's willing to lend it, to 80% of the cost of purchasing it based on what it's making. And then because you've got economies of scale with these people who own a bunch of them, they're able to bring the cost down, the profitability up. They can go back to the banks a few years later and say, we want to borrow more money. And they use that money to actually give me my money back. So if I put in $50,000 into a nursing home, I'd be getting small amounts over like the first 3 years. And then after 3 years, I might get a whole chunk. I might get $50,000 back in one. That's a refinancing. And at that point, I've gotten all my money back and my shares go from preferred shares to regular shares. So I no longer get that first 10%. Now I start getting, the money gets divided from percentage one, but it's only after they've paid it all back. And if they've given me $15,000 in payouts the first 3 years, they don't reduce that from the money they give me back. They don't give me $35,000 back if I put in a $50,000 investment. They still give me the entire $50,000 back. So that $15,000 was mine. Now they refinance me. They give me back all that $50,000. That money's not taxable at all because it's not earnings. It's borrowed money, and you don't pay tax on borrowed money. So I saved all this money on taxes the first year from the depreciation. I'm making money every single year on the payouts. I then get a chunk of money that's non-taxable. So I get all my money back. I can put it in another investment. And that first investment still gives me dividends, just at a lower level because I've gone from preferred shares to regular shares.
Okay. So say you were trying to do your financial independence math, like say, you needed 3,000 or 5,000 a month to live off of. Do you feel like you can do that with syndications alone? Just kind of being able to depend on the dividends that are coming out?
Absolutely. And certainly if you look at the amount of money you need doing these private equity deals, the amount of money you need to invest, it's far lower than you would need, say, if you were putting your money into index funds.
Yeah.
In fact, I actually use you and Craig as examples when I talk to people about different paths. I tend to find the FI community falls into the index fund group and the real estate group. And you'll see that the real estate group usually becomes financially independent at a much, much younger age or a much faster period of time than the index fund group. Now, these syndications we're talking about, they were a way for me to do real estate that was less hands-on. I'm not going to be making the type of returns that you will make doing it directly. So the period of time to become financially independent will be slower than if you're doing all of your real estate yourself. But you know what? I've got other income sources. I've got my business. I've got my books that I write. I don't want to be dealing with real estate, especially because I live in Israel and I'm investing in America. I don't want the headache. So I'm willing to have slightly lower returns than if I was doing the real estate myself, but it's still much, much faster path to financial independence than you'd get from index funds generally.
Great. So if somebody was interested in this, how did you find them? It sounds like you got some recommendations from friends, but in going forward, are you just kind of going off of those recommendations or new offerings from the same companies, or what kind of research would you recommend someone does?
It's really a networking thing. What I found is that here's part of the problem. You have to be an accredited investor in order to get involved in these.
Not all of them, but some.
Not all of them, but most of the ones that I'm involved in, and some of them allow me to self-certify as accredited investor, which is an important distinction.
Yeah.
But because a lot of these are accredited investor investments, they're not allowed to advertise. You can't go and Google these things. They can only kind of reach out to people who already know about it. And actually, the research for the cash machine and for the FI school that I'd interviewed you in years ago, these had gotten me just interacting with a lot of people who had their hands in the whole private equity world and the real estate world. And I just reached out to everybody I knew. And I said, do you know of anything? And I'd reach out to people and they'd make a referral to somebody else. And that person would say, oh, I don't have a deal right now, but I know some people who do. People in this world know each other. And a lot of this is word of mouth. A lot of it is networking. The first deals I got into were only because of networking. They 100% would not even take money from people that they didn't have some kind of a personal connection to. It was kind of a small group of investors. And they were happy because they were small enough. They were happy for me self-certifying that I was an accredited investor. I was borderline, honestly, because most of my net worth was in my business. And how much is a business worth? You don't really know. So as long as I can make a case that I was accredited, they said that's good enough for us.
Yeah. So I have a meetup, if you guys don't know about it. It's called Airbnb Investing. We have a group on Facebook, so that can be international and people help each other. And I go in and do lives every other week. And then we also meet in person here in Boulder, Colorado. And so that's a great way to meet other people that might know about syndications, that might have deals. Real estate is really about who you know. And we all just kind of help each other out. So it's really important to get out in the community and get familiar with people. So I highly encourage, go check out Airbnb Investing on Facebook, and I hope to see you there. All right. So let's go back to the accredited investor. So tell everybody what those, what the limits are there, because I think a lot of people probably are not familiar with that status.
So accredited investor status drives me absolutely nuts. I kind of like, you could see it in theory that, it's a good thing for people to say, okay, we don't want inexperienced investors getting involved in deals. We don't want people swindling those who are inexperienced. So we're going to say that people have to have a certain level of knowledge in order to be investing in certain deals. Now, the opposite of that is a public company. We say stocks are publicly traded because anyone can invest in them. The opposite of that is those that are not available to anyone. And that's what we say is available only to accredited investors, these private investments. But to me, we have the main character of the cash machine, Amber, at a certain point when she learns about this, she means, so what do you have to do? Like take some kind of test in order to show that you're like savvy enough to invest in these things? And of course, the guy, Vinny, she's talking to just laughs. It's like, well, like a driver's license? Like, yeah, that's way too logical for the government. Because the presumption seems to be that if you have enough money, you must not be a sucker, and it's okay for you to go. It's okay for you to go into these things. And if you don't have enough money, then you must be, really immature with money, and you can't be trusted with it to make your own investment decisions. And of course, this is total garbage. This is why so many professional athletes and lottery winners go bust so often a few years after they win this money, because having money doesn't make you money smart. And the accredited investor status just assumes that it's the amount of money that you have that determines whether you should be allowed to be investing in kind of off-market investments or not. I don't think that's right. I'd much rather see people who are educated and savvy and getting themselves an education on this stuff. Like your listeners are getting themselves an education. They should be able to get enough of an education that they could have any investment they want available to them. But that's not how it actually works. The government likes to say that there's one of two tests. There's the income test and there's the net worth test. The income test is if you have, you've made $200,000 a year, several years in a row, or if you're filing jointly with a spouse, $300,000 a year. And it looks like you'll continue to make that in the future, like you haven't just sold your business or lost your job, then you're accredited. Or if you have $1 million of net worth, excluding your primary residence. You are considered accredited, and then you can get involved in these different investments. And for someone like me, it's actually a really difficult question. Am I accredited? Am I not accredited? These days, it's a bit easier because I've got so many different investments now. But a couple of years ago when I was starting, I didn't have that much money invested in the stock market. I didn't have that much. I had sold my house. I didn't have real estate. I didn't have a lot of assets, except I had my business, which was making a decent amount, but not enough to be above the accredited investor thresholds. Now, what's a business worth?
Yeah.
I'm actually writing another book now, kind of a sequel to the Cash Machine. Totally different story, but it's more about the Cash Machine. I always said is not a book about how to make money. The Cash Machine is a book about how to make smart choices with the money you've made. So, but I always said, okay, I'll write a book later about small business and how to be making money and dealing with some business acquisition issues and how to be turning around a failing business. And as we point out in that book, there are over 100 different metrics for how to value a business.
Yeah.
And according to some of those metrics, my business was worth $1 million. And according to other of those metrics, my business was worth a tiny fraction of $1 million. So how did I decide what my net worth was? And this actually helped guide some of my initial investments, because a lot of the accredited investor deals used third-party accreditation services, and they used the most conservative of the business valuation tools to figure out what my business was worth. And so if I wanted to invest in a hedge fund or something, they would have said, nope, we're only actually going to look at your business as how much money it has in the bank. Everything else, we're not even going to pay attention to. And by then, no way I would have been worth $1 million. But because there were tools, there were perfectly valid ways of assessing a business that said my business was worth $1 million. Could I have actually sold my business at that rate? Probably not. But there were legitimate tools that said that. And, there are accountants who will make you write a whole accredited investor letter that will say, how much you are worth. And I approached the accountants. I said, are you comfortable using these tools? And they said, look, if they are published, well-known business valuation metrics, yes, I'm comfortable writing a letter based on those metrics. And you can then use this letter and self-certify that you are accredited. So I was really able to get into smaller deals where, again, everyone kind of knew each other, and it was more of a word of mouth thing. It didn't have to go through the third parties. So who is accredited and who is not as black and white as you might think. There are literally certain deals that I was able to get into that would consider me accredited, and other deals that I would not be able to get into because they would not consider me accredited, even though they're all using the same metric for accreditation. And one other thing I need to point out is that there's actually another loophole that could have gotten me into those nursing home deals, because every accredited investment deal has a certain number of slots for non-accredited investors. So it doesn't have to be that 100% of the investors are accredited. I think there's something like 35 exemptions for people who are non-accredited. So if it's a big deal, if it's like $1 billion real estate complex, forget about it. The odds of you getting one of those 35 slots are garbage. They're all given to like close friends and relatives of the people putting the deal together. But these nursing home deals, each nursing home was a small enough deal that there weren't even 35 total investors. So I could have gotten into those with one of the exempt slots, even if I wasn't accredited.
That's a good,
it's important for your listeners to know that if they're not accredited or have a hard time showing they're accredited, but they want to get involved in these deals, that smaller deals will often give them an option to get in on one of these exempt slots rather than having to hit the threshold of showing you're accredited.
I love it. That's a great tip. So how do people like interview these companies, or what are some things you look for? I imagine now you're starting to see more and more deals. What has you buy in versus not?
So first of all, I want to be making sure that these deals are really legitimate. I want to look at their track record. I want to talk to investors who've done past deals with them and know that, yes, they're paying out. They seem to be legitimate. A lot of that then tends to be, what are the deal terms? How much money am I likely to get out? And also, how much risk is there? I'm very into asymmetric risk reward. How can I really cover my downside to make sure that I don't lose money, but really have as much potential for upside as possible? In fact, I just entered a deal a couple weeks ago. It's not an accredited investor deal. It's not in this space at all. But one of the things I liked about it, it's actually for a small publicly traded company. One of the things I liked about it was that I'm putting money into the company, giving it to them directly. I'm not getting stock yet. I'm getting stock a year from now. And the deal is that I get the stock at the lower of two prices, either today's price, the day I put the money in, or the price a year from now. So if the stock goes up, it's a penny stock. So it's trading at like 12 cents. So if it goes up to 30 cents, well, I made almost, I made 2.5 times my money. I did great. But if the stock goes down, if it's worth 4 cents, I get all that, my money converted to stock at that 4 cent level. So if it goes down, they take the loss. If it goes up, I get the gain. So you always want to look at how can you protect your downside? How can you make sure that, there's people look a lot about gain. They look a lot about what's my return going to be, but it's really important to also know, what am I really risking? Is there a way I can get into a deal that is going to be protecting the downside? Now, very often there's a bit of a give and take on that, especially in these like the nursing home deals, for instance. Some of the deals that I looked at that were promising the highest upside also had the greatest risk of losing money. So let's take an example. Let's take 2 different nursing homes. One of them is making $1 million of profit per year, and they're hoping to take it to $2 million. The other one is losing $1 million a year, and they're hoping to take it from -1 to positive $1 million. So really, the one that is that is already making $1 million a year, your downside is pretty much protected. I mean, granted, things like COVID happened and that threw the industry for a loop that nobody saw coming. But when I'd look at an investment like that, I'd say, okay, there's already really good income. They already have enough money to be paying me out the minimum. The odds of me not getting my minimum return, that kind of 10% threshold, the first 10% comes to me, the odds of me not getting that are very low. But it could be that deal would have a lower cap and that maybe I get at most, 20% back each year on my money. Whereas the one that was at like $1 million of losses per year, well, there's no guarantee they're going to turn that around. They've got their projections for how they're going to do so. There's a higher risk that I'm going to get nothing back. But it could be that if they wind up being successful, that I'd wind up getting 40% returns instead of like the ceiling being 20%. So you need to be looking carefully at how much is that risk versus how much is the reward. How much risk can you handle? One of the things I started doing after I had these investments is I brought in a bunch of family members in. Like my in-laws wound up investing in some of these deals with me. And, I told them they're in a different spot. I said, I have more ability to handle risk at my age than you do at yours. You've got a set amount of money. You're retired. You need to make sure that you're getting your return. So I'd only have them in deals where the property was already making enough money to make the minimum payments. And if they got less upside, they were okay with that. They just needed to know that they've got a certain amount of monthly expenses and they're going to have that money coming in every month. And if, their bonus isn't as high, they can live with that. Me, I could handle more risk and I can look at things that are a bit riskier. I could try to diversify around into a whole bunch of different properties so that some would be winners, some would be losers, but I'd be willing to take the bigger risks to get the bigger upside in exchange.
Okay, well, it sounds like we could talk about this all day, but we actually need to move into the final part of our show. So do you have any final words of wisdom for the listeners before we transition?
I would say that getting back to the money mindset madness stuff, that there's the two sides. What we've been talking about tactics and strategies for making your money grow. That is really, really important stuff. And I love those things. But you have to also really be willing to do that introspective work to look at those places where you've got holes in your money beliefs, where you've got ideas about money that might not be the healthiest things out there that could be holding you back. Because for me, I was in the right place at the right time. I was making great money, but I didn't have a good financial blueprint. I had all this garbage in my head about money. And that's what caused me to get deeply into debt. Not that I was in the wrong business, but that I just didn't feel comfortable making money. And as I've been able to go and find those places and tweak those things, that's really what opened up the possibility for me to be growing my money greatly. So I want to always point out to people that it's kind of the external work of finding the deals and understanding the strategies, but also the internal work of making sure that you turn yourself into the type of person who can invest successfully.
Yes, that is really important. I feel like people lose sight of the holistic view, and it's very much like scorecard of how much money and what's my net worth and how many properties do I have. But really, there's just so much work inside that you can do along the way, and it's really important.
The final four.
So question number one, so I usually ask two and then Craig asks two, but Craig's not here today. So question number one is, what are you reading right now?
I'm actually reading Beartown at the moment.
Okay, what is that about?
Beartown is it's a Swedish novel about this small town into all this whole hockey town. The first chapter lets you know there's about to be this someone's going to go nuts and kill somebody else, but we haven't gotten up to that point yet. That's the novel that I picked up. I'd read one of his other novels and really liked it, and so picked this one up. So far it's sucking me in. It's pretty good, actually. I think they've turned it into a show on HBO, I believe.
Okay, great. So what is the best piece of advice you've ever received?
Wow.
As a rabbi, I imagine you've given and gotten a lot of really juicy advice.
I think I'll go back to The Size of Your Dreams. The Size of Your Dreams is the novel I wrote before The Cash Machine. And it was really based on how to be focusing my attention on what my goals were and then creating very clear steps for how to get myself there. And so that whole idea of just coasting, we had somebody who was coming to us today for advice because he said, I see the years going by and life is just passing me by. I'm not actually doing anything with my life. And you can't decide on anything. You're going this direction, you're going that direction. You need to have a very clear goal in mind. Even if it's not the one you ultimately stick with, you need to start moving forward and figuring out how you're going to get yourself there.
Awesome. What would you say is your why that keeps you on this path of investing and growing your finances?
Honestly, curiosity. It's not even the path of investing and growing my finances so much. When I really started getting into this stuff was when I started just being fascinated by it and wanting to learn more and wanting to grow. I'm just get so excited about learning new things and growing with them. And so the Cash Machine was really a project of passion. I loved researching it. I loved writing it. And I just loved learning new skills and new techniques and really a new approach to looking at the world. So that's really my why. I don't honestly need all that much more. I can't say I've got all of these things I'm looking forward to buying once I have more money. Really just love the journey of exploring and the curiosity. And the more I have a lot of that money I actually turn towards learning. We travel around the world and we go to these different seminars and we learn from the best people out there. We just love being in these environments and just growing ourselves.
Wow, that's great. This is a good segue into like the question number 4 is, what are you geeking out about right now? What is like the latest thing on your mind that you're just learning a lot about?
Business acquisition, actually, is I just did this course. I did something called the Harbor Club. And these guys specialize in buying businesses usually for $1, or actually they're based in England. So usually for a single pound. It's this technique of finding businesses that some of them are distressed businesses, or it could be a good business with a distressed owner, finding businesses that you're able to go in and pick up and turn around. Now we talk about getting, a 10% return, 15% return on some of these, putting your money into a real estate syndicate. But if you're able to go into a business and able to have those tools to turn that thing around, then the growth potential is just so many times greater than that. So I've been geeking out on that for the past month or so.
Interesting. Okay. Yeah. I mean, especially if you buy it for $1, you could, 10x that pretty easily or way more. All right. So where can people find out more about you and your books and your course, all that stuff?
Okay, so you can go to davemasonauthor.com and you can see all of my different books there. I'm happy to give everyone a free download of The Cash Machine. You can get that again at Dave Mason Author or just at buildmycashmachine.com. And it's a free download for you. And if you want to check out Money Mindset Madness, if you want to really work on your own financial blueprint and get to the bottom of what's making you tick and figuring that out and getting rid of all the garbage so that you can actually be making money, go to moneymindsetmadness.com.
Wow. Thank you so much, Dave. This was a great episode. Lots of good information for our listeners, and I hope they go and check out your books.
Awesome. Thank you so much.
And that was Dave Mason. Well, usually this is where Craig asks me, what did I think about it? I really liked the conversation. I thought that Dave brought in a lot of depth. I love this concept of, I think it's called Money Mindset Madness. That course, I almost feel like I want to take it. Like I said, I've been really wanting to write another book. I've been thinking a lot about how to formulate the book and how to work on my own money hurdles so that I can give that information to other people. So yeah, if it's something you think that you would be interested in, definitely reach out to me and let me know, because it's one of those weird things that when you get an idea, you're like, does anybody actually want this? Is this just me being weird? So I'd love to hear from you. You guys can reach out to me on Instagram at Ziana McIntyre, and I answer all my DMs. So please do. If you love this show, please share it with a friend. Follow us wherever you listen to podcasts. Subscribe, like it, share, comment. All of that helps. We really, really appreciate it. Well, we'll see you next week. We do these every Wednesday. See you soon.
That's it for this episode of Investify. We hope that these nuggets of real estate wisdom lead to more savvy financial planning and a clearer path towards financial freedom. For more content like this, subscribe to the show at investify.com. Don't forget to leave a rating and share it with your friends. Together, we can transform more real estate newbies into successful and clever investors. Thank you so much for listening. See you on the next one.